Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors. Today we're going to talk about 7 steps that you can take to get your financial house in order mid-year. But before we get to that, I'd like to talk a little bit about what's moving the markets right now. In addition to Facebook and the Facebook IPO that occurred last week, the Eurozone is definitely front and center. The commentary regarding the possibility of Greece leaving the Euro is getting a lot louder. European leaders are meeting right now, and we expect to hear some combination of some form of potential quantitative easing or printing of money over in Europe, as well as the possibility of some plans for how to manage any exits from the Euro, whether that be Greece or potentially also Portugal, Spain, Italy, etc. So that's definitely moving the markets this week and moving them negatively. In addition, we also heard some interesting commentary from the Fed last week about the possibility of additional quantitative easing here in the United States. And when that news came out, the market responded very negatively. A lot of analysts, economists, money managers started to opine on the costs and benefits of keeping these rates artificially low and what that's actually doing to our economy, whether it's actually stimulative or whether it's actually hurtful. And so I wanted to introduce 2 quick charts to just look at, and I know we keep talking about treasury rates, but it really is one of the most important things in the market these days. This is actually a 100-plus year chart of the 10-year Treasury rate, and you can see that right now our 10-year Treasury, which is considered the bellwether for interest rates, is at the lowest rate that it has ever been, down at approximately 1.7%. The last time that it was in this range was back in the Great Depression. So we really, we are at extremely low rates, as stimulative as they can possibly be, but it's not necessarily causing the market to move up. This next chart is also of the 10-year Treasury. However, it's just of the last 5 years, and you can see that our rates came plummeting down, and they've really stayed in this range. They have not moved up in the past several months, and yet it really has not been stimulative. So the concern now is that here we're going to have these exceptionally low rates. We can't go much lower. It's not necessarily stimulating, and in addition, it could actually be hurting more than it's helping, and hurting in 2 main ways. Number one, these extremely low rates really hurt savers, and as we're seeing in retired individuals and also those baby boomers that are on the verge of retiring that are going to be living off of their savings and living off of fixed incomes, it's very hurtful to these individuals if their income drops from, say, 3 or 4% to 1.7% of their savings. That way they're either going to be forced to, 1, not spend, which is bad for the economy, or 2, take additional funds out of their principal, which can create a big problem for them down the road. So that's one way that these low rates can be hurtful. The second way, of course, is with banks. The banks, which of course are maligned, of course, in the media, cannot make money when these rates are kept so artificially low. Even though the banks are attacked for not lending, they can't necessarily claim to be acting in the best interest of their shareholders if they're making money-losing loans at these exceptionally low rates. So it's a very interesting problem that we're seeing here, and certainly we're at a very important crossroads when it comes to Treasury rates, because if rates stay artificially low, it will be hurtful to several people, and it might actually hurt the economy more than it's helpful, even though it's designed to be stimulative. So it's very interesting. We'll have to see how this all works out. So those are the 2 main things that are moving the markets this week, the Eurozone and what's happening with interest rates. We'll be right back in a minute to discuss your financial house and 7 steps that you might take mid-year to keep your financial house in order. You're watching Money Matters. Please stick with us. We'll be right back. Welcome back to Money Matters. Today I'd like to review a 7-step mid-year financial tune-up that you might consider to get your house in order as we approach the second half of the year. The goal of this plan is, of course, to identify problem spots before they become significant money losers for you. And we'll review a few action items in each of the steps of this mid-year financial tune-up so that hopefully you can leave this show with a to-do list for yourself that will help you to get your financial house in order, again, as we approach the second half of the year. So step number 1 is going to be update your personal balance sheet. And this might be something that you've done in the past, or this might be the first time that you've done it, and it should take only about 15 to 20 minutes, less if you use some software such as a Quicken or a QuickBooks or some online service like themint.com, which I actually have a shot of right here that helps you to organize all of your financial information. So what you're going to do here is assess take all the current values of your all of your assets, your real estate, your life insurance, your annuities. Don't forget your employer-based retirement plans, your checking accounts, your savings accounts, etc. You might need to estimate values for your home. You can use tax values if you want to, maybe recent sales in your area. Really the point of doing this is, if you've never done it before, to create a baseline for yourself so that perhaps 3 or 6 months from now you can compare what your balance sheet looks like now relative to where you want it to be in 3 to 6 months. If you have done it before, then of course it's just a great opportunity to compare where you are right now to where you've been in the past, and ask yourself, which way is my balance sheet going? Are my assets going up? Are my liabilities going down, and therefore my net worth improving? Or is it going in the other direction? And then you ask yourself, why is this happening? What is it about my balance sheet that's moving either positively or negatively, and make changes accordingly? So that's step number one. And again, here is a great resource for that at mint.com. It's a free site. It's also run by the people that put together Quicken and QuickBooks. It's a great way for you to organize all of your financial information. Step number one. Step number two. Review your W-4. This is the form that you never look at, basically, once you pretty much become employed, unless your employer forces it in front of you again. But if you are employed and you earn a steady paycheck, meaning a paycheck that doesn't fluctuate with bonuses or production or something along those lines, now is a great time to review your W-4 and make sure that you're withholding the correct amount for taxes. And the way that you can assess that is, if you received a refund of more than $1,000 last year, and you don't anticipate any major life changes in the rest of the year, such as marriage, divorce, expecting new kids, etc., then you probably want to consider changing your level of withholding and stop overpaying Uncle Sam. That's your money. You might as well keep it now. One way that you can assess appropriate withholding for you is to go to the irs.gov site, and there's actually a withholding calculator that you can look at there and enter your information and perhaps assess a more appropriate withholding rate on your W-4 going forward. So that's number two, is assess your take a look at your W-4. Number three, look at your short, mid, and long-term savings goals and consider where you are relative to those goals at this point. So short-term goals, what might you be thinking about here? It could be, of course, vacation as we're approaching summer. It might be new tires on your car. Any type of a short-term goal that you foresee that's probably of a smaller magnitude. A midterm goal, maybe your house needs a new roof, or there's some home renovation project that you'd like to start attacking. Maybe you actually need a new car, or you're going to have a soon-to-be driving teenager. These are some things that might be in sort of that midterm range, potentially a little bit larger savings goals that you need to start looking at right now. And then, of course, we have the long-term savings goals such as retirement, college education, the larger goals, larger dollar amounts, much further out in the long term. So you want to consider contributing to each of these short, mid, and long-term goals in either equal amounts or whatever is appropriate based on the goals and the necessity that's there. So see where you are relative to those goals. If you don't have any, set them and adjust perhaps your cash flows and your expenses as needed to hopefully get closer to achieving them. Another great site to use is, again, that Mint or Quicken. This is a place where you can set up what those goals are and just track where you are relative to where you want to be. So that's number three. Number four, max out your IRA and or your Roth IRA, depending what your tax bracket is. That's $5,000 for 2012 is the maximum contribution that you can make. If you're over 50, that amount goes up by $1,000 for catch-up, and it becomes $6,000 for 2012. And you have until April of next year, 2013, to max out this contribution. One thing that you might consider doing now, if you haven't started doing it already, is automating this contribution. It's very easy to make a direct deposit on either a monthly basis or a bi-monthly basis. Sometimes you can even allocate a portion of your paycheck directly to a different account for that purpose, depending on if your employer allows it or not. Now's a great time to give your accountant a call or perhaps your financial advisor and ask them if you're eligible to contribute to a Roth. Check and see if your IRA contribution is pre-tax or post-tax and what that's going to mean to your tax situation next year. And then you also want to take this moment to review the investments that are inside your IRA or your Roth IRA. Are these investments still appropriate for your goals? Are they appropriate for your risk tolerance? Certainly seeing what's going on over in Europe and what it's done to the markets is making people question what their risk tolerance is. They thought they might have been able to take more risk before. Maybe they feel a little bit differently now. So consider, are these investments still appropriate for what I'm trying to do for my financial future? And again, also look and see, have the investments themselves changed? Are there better options that are out there? Has the mutual fund manager that you've been using for the last 10 years, has he moved and you want to move to a different fund? So really consider, are these the most appropriate investments for me at this time, and avoid that whole accidental investing that we keep seeing fabulous ads for on TV. So that's number 4, is going to be max out your IRA. So we've gone through 4 steps in our 7-step plan for our mid-year financial checkup. We will be right back in just a moment with the final 3 steps that you should consider as you approach the mid-year. This is Money Matters. We'll be right back. Welcome back to Money Matters. So we're discussing these 7 steps that you want to take mid-year to get your financial house in order, and we've gone over 4 of them thus far. So let's talk about number 5, which is review your employer-based benefits. And this is a pretty comprehensive activity. You're going to want to take a look at, 1, any savings plan that your employer offers, whether it's a 401k, 403b, simple IRA, and make sure that if you're maxing out that amount, that you know that the maximum amount has actually, the maximum contribution amount has increased this year to $17,000 from $16,500 last year. And also, if you're over the age of 50, the maximum amount that you can contribute is $22,000. So if that's your goal, then you want to make sure that you're on that track right now and increase the amount that you're contributing if you haven't already increased it from last year. The other thing that you might want to look at is, have you received a raise in the last year or the last few months, that you want to take that difference and put those funds towards your employer-based plan if it's appropriate. So take a look at that plan, take a look at the investments inside that plan. Have they changed? Those investments actually do change pretty frequently. I'd say, every few years anyway. So take a look at those investments, make sure that it's still appropriate for you and for your family, and that it still tracks your risk profile. The other thing that you want to look at with employer-based benefits is your health insurance. Chances are you're going to have to renew your health insurance elections before the end of the year. So now's a great time to look and see, how much money have I spent this past year? What is the situation for myself and my family health-wise? Did I elect the best option for myself and my family? Do I anticipate any changes over the coming months that might cause me to elect a different plan when that option becomes available in October? So that's health insurance. And then the last one, if your employer offers flexible spending benefits, these are the use it or lose it benefits that you can put, that you can take directly out of your paycheck pre-tax and use for use for medical related issues and also for childcare. So if you have a flexible spending account and you haven't actually applied for those funds and you've been using them, get those receipts out, go fill out the forms, send them to your benefits company, make sure that you get reimbursed for those funds, and also take a look at the remainder of the year. You have 6 more months left, and you want to make sure that you zero out those flexible spending accounts between now and the end of the year, because it's a use it or lose it situation. You don't necessarily just want to leave money to the insurance company. So take a look at that right now. If you might need to get some kind of eye surgery or something along those lines, make those plans for that now, for how that money is going to be used most effectively before the end of the year. So that's number 5, which is review your employer-based benefits. Number 6, pull your credit report. Every year you're entitled to 1 free credit report from each rating agency, from each of the 3 ratings agencies. So consider staggering these perhaps and just pull 1 right now and then pull another, say in 3 to 6 months, if you're trying to improve your credit or if you see something on there that you're trying to change. The place to do this is going to be at annualcreditreport.com. It's not freecreditreport.com, which is kind of a misnomer. It's annualcreditreport.com is where you go to get your 1 free annual credit report from each of the 3 agencies. And again, I would definitely strongly consider that you stagger those. What do you want to do when you pull your credit report? First, you want to make sure your identity hasn't been stolen. Confirm that all of the accounts that are there are actually yours. If there's a credit card that's listed there that you didn't apply for, that's definitely a trigger, and you want to make sure that you address that immediately. The other thing is, if you've been divorced in the past, make sure that you have no jointly titled accounts that are still open and expose you to the spending of your former spouse. That can be a huge risk. So make sure that any of those formerly jointly titled accounts are closed out. The other thing that you want to see is, are there any errors? If there's any errors of accounts that are still showing as open or past due or something that's not correct, make sure that you attack that right now because it can take anywhere from 3 to 6 months to actually up your credit or improve your credit when you correct those mistakes. So make sure that you're looking at all of those factors, especially if you're going to consider applying for a loan in the next 3 to 6 months, be it a mortgage, car loan, car lease, anything along those lines. You want to make sure that your credit is as strong as it can possibly be so that you get the best possible interest rate. So correct any of that erroneous information. Send the credit bureau a letter along with any documentation of any of the corrections. Send it to the vendor so that hopefully it will improve the speed in which you can correct that. Also, review the debt levels on each of your credit cards. Are they correct, number one? But then you also want to make sure that ideally you want to have your debt level be 35% of the available balance on each of those cards. So let's say, for example, you have 4 cards, but you only use one and it's charged to the max. You might actually want to move some of that balance and spread it among the different cards so that it can improve your interest. It will improve your credit rating by bringing that debt level down relative to the total on each card. It's not cumulative, it's per card. It's also a good time to go ahead and review your monthly debt expenses relative to your income. Ideally there you want to be looking at somewhere between 15 to 25%. Of course, you'll hear 25%, that's pretty high, but ideally you'd like to keep that debt, that monthly debt amount to approximately 15 to 20% or so of your net income. So that's number 6, is pull your credit report. And then number 7, create an action plan and document it. So we've gone through these 6 steps right now. Chances are you have a couple of to-do items that are in there, whether it's putting together your balance sheet, pulling your credit report, whichever of these steps might be something that you haven't done just yet. So put together that list of to-dos and give yourself a time frame in which to do them. Go ahead and set an action plan, put that timetable on the calendar, do it this month so that when you get to the next month, you'll have another to-do item. And I promise you 6 months from now, when you follow up with this, you're going to feel very proud of yourself and all of the accomplishments that you've made towards all of your financial goals. Now that we've covered these 7 hopefully helpful steps, let's go ahead and move to our closing. If you can't complete all of these steps, or if some of the action items seem a little bit too daunting, set a goal for when you can address them. Perhaps your cash flows don't allow you to address some of these savings measures right now. Perhaps you have surprising expenses that have come along. Just set a goal for when you might actually address this situation in the future. If you feel that you're going to cover these new expenses in the next 6 months, put a note on your calendar to take a look at these 7 steps 6 months from now when you actually feel like you can attack them and start to get your financial house in order. Don't just let it fall by the wayside and surprise you in the future. And if you need some kind of an incentive, perhaps if you're one of those, create small rewards for yourself along the way. When you've met a savings goal, perhaps add something small onto it for yourself, some sort of an incentive to help you achieve those goals and look forward to those goals in the future. So that's sort of my parting shot, if you will, following up on our 7 steps. The other thing that I'd like to address, though, again, is getting back to these interest rates and how you might want to take a look at your portfolio right now. Again, we're at historically the lowest interest rates that we've actually ever seen. So a few things you might want to consider. 1, refinancing your house. I know we always have David Kroll on here espousing the benefits of that, and I have to second that right now. Mortgage rates are at the lowest that they've possibly been. So if you have the ability to refinance right now, even if you've done it in the last year, it's probably worth considering because rates have dropped precipitously on mortgages, on long-term mortgages. So definitely consider doing that if you have the ability. The other thing is, I would strongly consider taking a look at your bond portfolio. See, what kind of exposure you might have to any interest rate increases. What types of bonds do you currently hold? If you're pretty heavy in the Treasury market because of fear, I would strongly consider paring that position back little by little. Because at some point, these 10-year rates will have to go up. The 20 years and the 30 years will as well. Whether it's due to positive economic stimulus or potentially negative economic stimulus as well. Interest rates will eventually have to turn. So look at your exposure right now. These rates are as low as they possibly can be, which means that the principal value is probably as high as it will be going forward. So go ahead and take any gains that you might have there now. So that's sort of my parting shot from an investment perspective for the week. Hopefully this has been helpful for you. Please send us your ideas. We welcome your ideas. We love your comments. Send them our way on Facebook. Shoot me an email. Give me a call. I look forward to hearing from you. And until next week, this has been Money Matters. I'm Emily Johnson. Have a wonderful week.